Hello, this is the Ordinary Investor welcoming you to today's video, and today we'll be taking a look together at a very interesting company, which is AbbVie. I recommended this company for purchase on Patreon about a month ago, and since then it's up by around 20%. Today, we'll take a look at this company together and try to find out whether it still represents an interesting buying opportunity. So sit back and enjoy the video. But before we begin, let's first get acquainted with this company. AbbVie is one of the largest biopharmaceutical companies in the world and focuses on developing innovative drugs for the treatment of serious diseases. Its research is primarily focused on autoimmune diseases, oncology, neurology, and also aesthetic medicine, and thanks to its drugs, it helps tens of millions of patients around the world. And every year it invests billions of dollars into research and development of new therapies. Among its most important products today are primarily Skyrizi and Rinvoq. These are modern drugs intended for the treatment of autoimmune diseases, such as psoriasis, Crohn's disease, or rheumatoid arthritis. And it is precisely these two drugs that are currently the biggest drivers of the company's growth. And just take a look at this. The average annual growth rate for Skyrizi over the past 6 years has been more than 90% year over year, and Rinvoq is growing at even triple-digit rates. A very important part of the portfolio is also Botox, which is produced by AbbVie. We all probably know Botox, so it doesn't need much introduction. We associate it with aesthetic medicine and wrinkle smoothing, but today it is also used to treat chronic migraines, muscle spasms, and certain neurological disorders. If we look at recent history, just a few years ago, the most important product for the company was the drug Humira, which was one of the most successful and best-selling drugs in the entire history of the pharmaceutical industry. But after the patent protection expired, Humira began to face cheaper competition, which led to a decline in its sales. But what I like about AbbVie is that it is very creative and has introduced two new successful drugs to the market, namely Skyrizi and Rinvoq. And these two drugs have become the main drivers of the company's growth. So I hope you enjoyed the introduction to AbbVie, and let's move on. If we look at the company's finances, we can see that the company is once again starting to move in the right direction. Earnings per share had stagnated for a long time and were even declining, but in the next 12 months, an increase of 47% is expected. If we look further at the revenues, we see a very similar picture here, where revenues had stagnated for a long time and were mostly declining. But after this rough period, the company has recovered and we are starting to grow gradually again. And now we are growing at a rate of 10% year over year. If we look at this company and consider the stock value, the company has experienced quite a volatile period over the past year. But if we look at the dividend despite this period, the dividend has been continuously increasing and at a very rapid pace, and that is really positive news for dividend shareholders. The company pays a dividend of around 3.5% annually, and if we also include its annual appreciation, which is more than 34%, then this combination makes a lot of sense to me. And you might be thinking that the current PE ratio is really at crazy levels, where we are currently at 191, but the forward PE ratio is only at 17.4. So if we compare this to the 5-year average, which is at 14, it tells us that the stock is currently overvalued. But if we compare this PE ratio with the entire healthcare sector, we are at exactly the same levels. And that could indicate that the company is fairly valued. What I also like about this company is its decreasing earnings payout ratio. This means how much money the company has left to potentially increase dividends. So we should be below 50%, and in the next 12 months, a decrease to a healthy 46% is expected, which means the company will still be able to continue increasing dividends. AbbVie was also a company that had issues with margins for a longer period, where the operating margin was gradually declining, as was the net margin. But in 2025, there was a rebound and the margin started to increase again. If we look further at the company's debt, it's not exactly exemplary, since the debts amount to more than $61 billion. But it's important that the debts have decreased by about 10% over the past year. And if we look at net debt to EBITDA, we should be below 1.5 years here. Net debt to EBITDA means how many years it would take the company to pay off all its debts and obligations. Currently, we are at a value of 2.5. This means it would take the company about 2.5 years to pay off these obligations. But in the next 12 months, a decrease is expected, and that's a positive sign. However, we are still not at truly healthy levels, and maybe you noticed that I used examples from Patreon at the beginning of the video. And that's true, because it was on Patreon that I recommended this company for purchase exactly 1 month ago, when the company was trading at around $217 per share. And since then, from those $217, the company has already gained almost 20%. So I think that's quite a nice appreciation over the past month. And it also turned out for me that according to the DCF model, the company is undervalued, and we calculated the fair value of the stock to be around $250. And Wall Street analysts expected growth to $257 per share. And now, after just 1 month, we're at $255. If we look at today's valuation, it doesn't make as much sense to me as it did a month ago. So if we look at the chart of the blue tunnel, which shows where the stock price should be, we can notice that the company is very often traded at some premium values. And we can also see that in the past year, there was only one period, specifically in May of this year, when the company was trading below its market value. At the moment, we are therefore above this blue tunnel, which is a sign that the company is overvalued. And it's no wonder that investors like this company because it continues to invest in its future. For example, the company recently invested $11 billion in another healthcare company, namely EPG Therapeutics. And thanks to this acquisition, the company gained about 60%. And if you're interested in what this company does, let's listen to this short segment.
What they're acquiring today is atopic dermatitis, known to mere mortals like you and I as eczema. And that is where you get endless itching and you get flaking of the skin. It's not quite as inflammatory as psoriasis, but that's what they're buying today, something they can add to their portfolio. At the same time, after 2030, because this
type hasn't even started before the third race yet. So I think this is definitely a very interesting acquisition. But let's move on. Wall Street analysts do not expect any upside for this company in the next 12 months, only about a 2% increase. And that means the company is not expected to outperform the S&P 500 index. And now let's go ahead and calculate the fair value of the stock using our favorite DCF model, where we've set only the realistic growth scenario, which means a 7% growth rate. Here, the fair value of the stock came out to $232, which, compared to the current market value, represents an overvaluation of 7%. That means we are at level 4, and at the moment, this is an overvalued company. However, if we look at our second valuation model, namely the dividend discount model, the fair value of the stock here came out to $292. So this represents an undervaluation of about 14%. So in order to calculate the fair value of the stock, we had to average these two values and we arrived at an intrinsic fair value of the stock at $262, which compared to the current market value represents an undervaluation of 3%. And on top of that, as a bonus, we have a 3% dividend. So this tells us that the stock is currently fairly valued. So we found that the stock isn't exactly cheap at the moment, and I would definitely wait for better prices. In any case, I like the whole story of the company, and I think this firm really has a promising future. I haven't mentioned any risks here, but the main and key risk is definitely the expiration of patents. So this is something I would definitely keep an eye on and be cautious about over time. And now we're getting close to the end of the video. I'm curious to know who among you invests in this company and what your average purchase price is. If you enjoyed the video, I would really appreciate it if you leave a like and subscribe to this channel. Don't hesitate to write in the comments which company you would like to see covered in the next video, and maybe next time luck will smile on you. That's really all for today's video. Thank you all very much for your attention, but most importantly for your support. Take care and goodbye.